Welcome to today's episode of the Michael Yardney podcast, and this is a replay of a recent webinar that Brett Warren, Ken Race and I did where we answered the viewers' questions, and this is a great Q&A session today. It goes a little bit longer than the normal podcast, but I think you're going to get great benefit from it because if others ask these questions, you'll probably thought the same. So some of the questions we answer is, should you buy in the outer suburbs where there seems to be cheaper properties? We discuss about how some buyers agents are inflating prices in so-called hotspots in regional locations. We answer a question about where's the best place to invest for the next 5 years, talking about living off equity, commercial properties and when's the right time to introduce commercial properties or cash flow. Should you take a principal and interest loan or interest only loan? And there's quite a number of trust questions and structuring questions and estate planning questions that Ken Race just answered as well. So we covered a whole lot. So at the end of today's show, you should have a better understanding to help you through some of the chaos and confusion that's currently happening with the things that property investors want to know, in fact, need to know to become successful. So once again, thanks for coming back to the Michael Yardney podcast. Let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hello everybody, welcome to our webinar, our Q&A webinar, Unlocking Wealth, your property questions answered. Thanks for joining me, Michael. How are you today?
I'm great, thank you, Brett.
Always good to see you, Ken, as well. How's things down in Sydney?
Good stuff, Brett. Hi, Michael.
Good to be with you again, guys. This was very popular last year where we got into a few really important things, and we also had the opportunity to answer a few questions as part of this process. Hopefully everyone can hear us loud and clear. Hi, Craig. Hi, Rob. Greg, nice to speak to you. Brad, thanks for jumping on. Just a reminder, there is a Q&A section there in the chat box as well. We're probably not going to get time to answer all questions today, but we may be able to answer a few towards the end. And if not, then we can certainly take those questions and format as part of the next one. Really looking forward to getting into this. So you guys have made time to make this work. So without further ado, let's start to get into some of the questions. And again, just a bit of a preempt here, guys. Like we normally say, we don't know your personal situation. So this is general advice, specifically if it comes to super and trust with Ken. So without further ado, Michael, first question's for you. In the hot seat, it's from Holly. It seems the latest trend for investors, some driven by interstate buyers agents, are targeting cheap properties in the outer suburbs of Melbourne, including Tarnett, Craigieburn and Roxburgh Park. What do you think of these suburbs?
Okay, thanks for the question, Holly. And the answer is, I think you're going to find as we keep talking today that we believe there's opportunities in Melbourne, but not everywhere. Look, Melbourne property values remain below their peaks, the 2022 peak, and more affordable properties have outperformed over the last couple of years. In fact, the upper end of the Melbourne market has been very flat and property values have dropped a little bit. And interestingly, that's one of the things that affected median property prices being reported in Melbourne. But affordability constraints are going to affect these outer suburbs as interest rates start falling. So we always suggest that you end up buying, where you can, properties in areas where people can pay more for their properties, where they can pay more for their rent because their wages are going up. So it's not just owner-occupiers, but you want tenants to grow, to be able to grow their wealth as well. Now, actually, Brett, if you don't mind, I'm going to actually do a little bit of a side discussion on the same thing that I think Holly's brought up something interesting, because a lot of people are chasing the next hotspot or the next shiny toy. And a lot of interstate buyers agents are now talking about the cheaper suburbs of Melbourne. There's a new wave of people on social media many of them new firms of buyers agents that suggest you buy the next hotspot that they've identified with all the data. They've been doing the research and they're suggesting investors ride the short-term wave. And then sometimes they suggest sell up and look for the next hotspot.
Yeah.
Now, Holly, and people listening to this, I can understand this is compelling. You're looking at the new fad, get rich quick. It feeds the greed glands of many beginning investors who are in a hurry to grow their wealth. But my concern is that many of these new buyers agents are sourcing their information from the same data and probably think they're the only ones who know about these. And they're telling people, hey, we found these new suburbs, like the ones that you mentioned, Holly. The problem is others are using the same data and they tend to put their clients in the same suburbs, which in my mind creates a degree of artificial demand and pushes up prices. And this feeds on itself as it supposedly confirms that the research they were looking at was right. Now, a really good example of this was Townsville. It was one of the hotspots many of the new buyers agents recommended over the last couple of years. Now, regional towns like this, even if they're relatively large, they don't have many properties available for sale at any one time, and even fewer what we'd call investment grade properties for sale. But these buyers agents, they've got to buy something. And they usually buy sight unseen. And that's what they're doing, these interstate buyers agents, buying in areas in Melbourne that I've lived here for 70 years and still have never been to those suburbs. We're seeing situations where, I don't know, there could be 50 potential interested investors and only 30 properties for sale in the region. And this suddenly pushes up values. Well, it doesn't push up values. I'm sorry. It pushes up prices, not values. And these buyers agents tend to buy prices the locals wouldn't pay because they know the true value of the location. Of course, we know, unfortunately, what's happened to Townsville recently with the floods. There are many locations in northern Queensland Metropole wouldn't invest in, would avoid because they're becoming uninsurable. So to answer Holly's question, and I apologise, Brett, I've taken a long time, is you've always got to ask what is going to increase property values in the future, because it's usually local economic growth that's going to lead to prosperity of local businesses, rising wages, so owners can pay more for their properties and tenants can pay more for the rent in those locations. So at Metropole, when we do research, we overlay the short-term market factors together with the long-term fundamentals to ensure a continuous strong demand for properties for 10, 15, 20 years. So when you're considering location, make sure there's a strong case for the location to outperform over the long term, because effectively the current wave of buyers is pushing it up in the short term, but against the long-term fundamental drivers. So thank you for the question that's allowed me to go on a bit of a rant, Holly. I understand why people are looking to invest there because it looks cheap. Cheap is what you pay, price is what you pay, value is what you get. Thanks, Brett.
No problems, Mike. I'd be a bit wary also, just to add, if you are looking to enter the Melbourne property market, one thing I'd be extremely wary of is buying in investor hotspots that are dominated by investors. The government's putting in huge disincentives for investors, land tax, all their stamp duty issues, and the tenancy laws are only really going one way. So it's actually a concern for me. And I actually think it'll be the Melbourne property market will be driven by owner-occupiers. So I'd be looking for those more affluent owner-occupied dominated suburbs rather than going for cheap locations where investors and, spruikers and cheaper people are looking, because there's going to be a level of safety in that and you're probably going to outperform as well. So there is a level of risk there. And Ken, I guess to bring you into this, speaking of risk, if someone, I've got Athena asking a question, that if someone's looking to set up a property in their own name and pass it on to their children with minimum cost paid and tax expenses, how do they set that up properly?
Yes, thank you for that question, Athena. Well, there's two issues, and I'll give you the morbid answer first. If you die, you can pass on those assets to your children without taxes. But a lot of us want to live a long and prosperous life. So if it's in your name, you pass it on while you're alive, there's capital gains tax and stamp duty to take into account. And if you buy it in your name, some people do as the agent for their child, then there's the minus tax. So that tax rate starts at 66% and on a sliding scale down to 45%. So that doesn't really work. A lot of our clients have the same question in mind, and for some of them it's appropriate to use a trust to buy the property and then change control of that trust at various points in time when they want to move control of the trust that owns the property to their child, and there's no taxes involved in that. But caution, trusts don't work for everyone, and there's different types of trusts. Some work, some don't. So you need to get specific advice on that.
Okay, Brett, I'm going to chip in and actually get you to answer a question that Maria asked. And I think it's a good one. It'll help a lot of people who are watching this and listening to this. And her words were short and sharp. How to start, what to look out for, how to maintain the strategy you decide to use.
Yeah, look, I think that's a great question. I know many people come to us wondering where to start. They hear about this property investing thing and what are the first steps. I think we take a leaf out of Stephen Covey's book and talk about beginning with the end in mind and understanding where they'd like to get to and what their end goals are. In reality, people don't necessarily want a property or invest in property. They want what the property brings. So I think understanding the long term, what they want to get out of it, then having the ability to reverse engineer things. Because once they understand where they're going, we can then put the vehicle in place to help them get there. A part of that vehicle, there's three things in my mind we have to get right. The first thing is, seeing as though Ken is here, is exactly what he just spoke about, getting the structure right. And that's something we do at Metropole as part of the first steps, making sure we're getting the entity and the structure right to protect and get that in the right name. The second thing is understanding their finance and also understanding their borrowing capacity and budget. And then finally, we talk a little bit about the property and the areas and locations we should look at. But isn't it funny, Michael? A lot of people do that the wrong way around. They start with a property and they make everything else fit, don't they?
Well, that's one of the things that a number of questions that we're not going to answer all of them, but today people asked about particular suburbs or which state to start in. They start at the wrong end, Brett. You're right.
They do. So begin with it in mind. Seek the assistance of a professional for three major things: your borrowing capacity. Make sure that's set up efficiently with a buffer in place. Make sure you're structured right. You've got your assets protected or in the right name. And the third thing is take an evidence-based approach. Seek independent advice. Look at different markets and different opportunities to make sure you get that right. And that's exactly how we can help people. One suburb, I guess, that's come into frame at the moment, Michael, that we're doing a fair bit of analysis on is Victoria. I've got a question from Ross here around why has it generally been underperforming, and when and what do you see the turnaround coming?
Gee, that's a common question, isn't it, Brett and Ken? Yeah. And there are lots of reasons why the Melbourne market's underperformed, but I think you can put it almost all together in one thing: lack of consumer confidence and the poor state economy, state economic activity. People look at days on market and auction clearance rates and number of properties for sale, but in my mind, these are the two big factors that affect our housing market. Look, much has been said about the state government's increase in property taxes. I mean, they're doing that to offset the huge infrastructure projects they've got, or other obligations that they put on landlords with minimal rental standards. But even though some investors with a short-term focus have left the market, interestingly at Metropole, we're seeing more and more interstate investors now looking at the current market, but really it's owner-occupiers that drive the market, and it's underperformed for a number of years, and it's really because of lack of confidence. And in my mind, Melbourne market's undervalued compared to the long-term trends. I've been around long enough to see this pattern play out before. The best opportunities often emerge from assets that have underperformed for a period of time, while in fact the biggest risks are usually when the markets have been running hot for a couple of years. Now, that's not to say that every property in Melbourne's guaranteed to outperform from here on, but when you look at valuations, recent performance and the long-term patterns, and you see that the gap between Melbourne and Sydney hasn't been as big as this for over a decade, it makes you think, well, maybe Melbourne's setting itself up for some interesting times in the year ahead. Brett, I think it's a good time to remember Warren Buffett's comments about be greedy when others are fearful and be fearful when others are greedy. But to answer when, it's when confidence returns. Will that be when interest rates fall? Probably that will be the first step in confidence, and then probably after the election later this year too.
Funny, I think we're starting to see these early signs that rents have risen quite substantially. If we start getting a few interest rate cuts and rents keep going up, I think that's the time that will spark potential owner-occupiers to make that change when it becomes cheaper to buy than rent in some cases, and that generally sparks that. So it'll be interesting to see if that plays out well.
Yes.
Ken, I used to listen to you over a decade ago, and when I first started investing, I purchased in my own name. So one of the common questions I always thought is, oh, geez, it's too late. I've bought in my own name. Can I introduce a tax structure at some stage to an existing portfolio? What would your answer be there?
Yeah, great question there. I think it was from
MASH.
It's from MASH. Clients use, or people use trust for one of a number of reasons. asset protection, tax planning, estate planning, flexibility. So for the majority of those, if you've got a property in a personal name and you move it into a trust, that's seen as a change in title, which it would be, and therefore trigger capital gains tax and stamp duty. But if, on the other hand, you are looking at this from the angle of asset protection, which a lot of people are now becoming more and more concerned with, given the number of litigations we see, then what we do is we don't physically move the property to a trust, we move the value. And given that we're not in love with the bricks and mortar, so to speak, but more with the money, moving the money over into a trust doesn't trigger capital gains tax or stamp duty. And then we protect the equity within that trust. So you've got to understand why you're doing it. And for some of those reasons, minimal taxes to no taxes, as opposed to, I just want to change the name because I want an improved tax position, then you've got to pay capital gains tax and stamp duty first.
Brett, I'm going to throw one at you now from Chris, who writes, I'm in my late 50s. Oh, look, by the way, as Brett said, we won't get through all your questions, but in a short while, we're going to give you an opportunity. We'll show you how you can actually have a chat with one of our wealth strategists and ask them your specific questions if we don't get to yours. And we haven't been able to answer some of them, Brett, because they've been too specific related to people, and that would be wrong without knowing more information. But Chris says, I'm in my late 50s and we're now in the position of being able to pay out our home loan in full. Well done, Chris. Should we do this first or just keep a small amount owing, or do we just pay it out and look at a plan to buy some investments, rentals, shares, bonds? Looking forward to joining you next Thursday. Well, here we are, Chris.
Yeah, thanks, Chris. Look, this is a really good question, because this is exactly how we help clients. We've got 3 or 4 different scenarios here that you could potentially do. Now, we don't really or can't give advice on shares and bonds, but certainly understanding we could fast forward at least 15 odd years, or 10 years in Chris's case, to help him understand which position he may be better off in. So I guess understanding that he's got another full property cycle to go, there may be some more value in obviously investing in other property. So discovering whether we do that, whether we pay down, whether we invest further. In my mind, it's probably an opportunity to consider investing further, because he's going to broaden his horizon. Again, depending on if he's got any other properties or assets, it might be an opportunity for him to grow his wealth a little bit more, and speak to someone like Ken about, so when he does retire, is it an opportunity to sell a property or live off some super and let the property play out? So these are the kinds of scenarios we work with. And Chris, if you've got the opportunity to sit down and model these types of things out, it's probably more than a simple discussion, but I definitely think it's worth considering investment given your age. If you're 5 years out from retirement, maybe not, but if you can get through a full property cycle, maybe 2, it's certainly worth considering investing your money, particularly if you're managing to pay your home loan without too much stress. Michael, back to you. We've got a couple of questions here. The first one is from John Cosmos. If you had to invest in real estate or property in the next 5 years, which state would you invest in?
Now, Brett, that's interesting, because that gets back to the question we said a moment ago of which state, which suburb, which location. And I wouldn't start with the state, and I wouldn't start with the location. That comes at the end. You need to know what your end game is, and then have a strategy, a proven strategy, a plan to get there. So we've mentioned a couple of times about this, just like with the question you asked a minute ago, Brett. So when you sit with one of the wealth strategists at Metropole, we use very powerful software to map all this out. So I know you've asked 5 years and you've asked a state, location, John, but please excuse me if I explain that's the wrong order. So for many people, the end game is something like you own your own home with no debt when you eventually retire. You have a property portfolio with a level of debt, and you have some things that bring cash flow in, which could be commercial property, could be bonds, it could be ETFs, it could be managed funds. And so you need a blend of those things. So your job between now and then is to build an asset base to get you there. Between now and then, the government's going to change, interest rates are going to change. I don't know if the banks are still going to lend you money as easily. I don't know whether you're going to be able to use your superannuation at a particular age, or the government changes things. So we know the rules are going to change. So therefore, it's really important not just to own the strongest assets, but also own them in flexible structures, which is something Ken's mentioned a couple of times. So flexibility is important as well. So that all comes before which state. Where's the right place for me isn't the right place for you because I'm at a different stage in my career. I don't know your budget, your timeframes, your risk profile. Do you need a balance of cash flow as well as capital growth to be able to hold the properties? What other assets you own? So, John, I know you'd like to know the secret of where to invest. If I gave you that, I'd be giving you the wrong information because that comes right at the end.
Thanks, Michael. Ken, back to you. Dean's asked a question. Do I get all the tax benefits if I live in our house owned by a trust?
Great question, Dean, and that's one that's very often asked. So there's two tax benefits that most homeowners want, and that's the exemption from capital gains tax if they sell, and the land tax exemption. So I'll give you the easy answer first. If someone passes a house to you on their death, they can put it in a specific type of trust, and then you can live in it and get the capital gains tax exemption and the land tax exemption. But that's only available on the passing of somebody on their death through their will to, as I said, a very specific type of trust. A normal trust, the state governments, being how they are and how they operate, don't tend to give you a land tax exemption if it's in a trust, unless there's special circumstances, a disability type scenario for someone living in it. So capital gains tax is then the next one to look at. And in some instances, you can I use the term a right to occupy? And the trust can give you that right to occupy. And if that is correctly worded, then the Australian tax system will give you the benefit of the main residence exemptions, which is zero tax on capital growth while you're living in the property and using it as a property. But that's a very technical document.
So really, I know a lot of our high net worth clients do that, and I've got a really, really good landlord who pays for a lot of my expenses. It's one of our companies, but it's all had to be set up very correctly by Ken, and everything's got to be documented, and we're paying a top rent. And we've, a year or two ago, had a very detailed tax audit and have proved everything. So it's a nice idea, but you really got to get correct advice, don't you, Ken?
You do. And just picking up on that point you made, you've really got to decide if the property is in a trust, do you want the tax benefits, the ongoing annual tax benefits? I'll call it negative gearing for want of a better term. Or do you want the free capital gains tax?
Yes,
so
you can't have
both. It's one or the other, and then you set it up correctly to achieve that end goal. And we keep using the words, what is your end game? And then we work backwards. So maybe I'll pass over to Brett. We've got a good question here from Shane. Hi guys, does Metropole ever buy houses in regional areas if the budget doesn't allow to buy in the city areas, e.g. budget 450, 475, but still want to buy a house, but not a unit apartment or a townhouse?
Thanks, Ken. Yeah, look, it's a common question. Obviously, look, property investing isn't easy, and you've got to save a deposit, and there's entry prices and stuff. I think around the 475, 500, there are some locations that we would still consider at the moment to buy in. Very, very few, but we would focus on the capital city rather than the regional. Look, particularly at the moment, I think everyone can agree. We've done a lot of analysis of this over probably the last 3 or 4 months, particularly the last decade or so in regional areas. There's been a period of about 10 years of zero to negative growth. And all of a sudden, it's peaked up and done 20% in 3 years. So I believe that it's going to take time for those incomes to adjust and things to change. And I also think it's probably going to be another 10 years before they get back to that point. So I think there's more value in a capital city. I do. In certain capital cities. I also think there's less risk involved in those types of locations. But I think the big mistake people make is assuming that a house it's definitely got more land, but a house has more land value than an apartment, because that's not necessarily the case. You could buy an apartment in Melbourne or Sydney where the land value might be $4 million and you've got 4 in the complex or 6 in the complex. And that land component is still quite valuable. So for me, one of the questions I most ask people is which part of a property that you're buying is going up in value? And it's obviously the land, but it's the land value, not the land size. So sometimes an apartment with a land component can actually be worth more and actually do better There's also supply and demand issues with units you've got to be careful of, like there is in regional areas where there's a lot more abundance of land. But for mine, I think a good opportunity still exists in capital cities at that price level. And if I couldn't get to that budget, then I'd hate to say it and be a bit boring, but I'd probably keep saving until I actually could. Michael, back to you. We've got a question here from Mitch. For a PAYG earner, once my servicing threshold is reached for a few investment properties, how do I grow my portfolio further? That's a common question I get asked.
Isn't it? Sure. So I've got a book behind me here on the bookshelf that says, it was a story about somebody who bought 130 properties in 5 years, and people think, hey, I'd like to do the same as well. It still annoys me that it's in the bookshops when, first of all, the author never owned 130 properties. It was a vendor financing he did. And secondly, that was before the global financial crisis, and finances are very different since then. So it isn't easy, and everybody has their limits, Mash, whether it's they're limited to a small amount of properties or a large amount of properties. And sometimes you just have to hibernate for a couple of years. You cannot keep going up and up, buying more properties. In fact, it's better to hold off, as Brett just suggested a moment ago, rather than buy a secondary property in a regional location until you have enough equity. So you need a combination of two things: equity, and that's why you need capital growth, and you also need cash flow. So over your investment journey, I believe you need two businesses. Number one, you need a cash flow business to bring in cash flow, and that business is your job, your profession, maybe other investments, and also a capital growth business, your real estate business, which is going to grow. And so residential real estate's a high growth, relatively low yield investment. And so as you have the cash flow to service your property portfolio, over time, you'll then be able to get your next property. But if you don't have capital growth, you won't get the next deposit. You can't save the next deposit with a couple of dollars of after-tax cash flow.
Thank you, Michael. Ken, a question with regards to super here. How do I go about establishing a unit trust structured for property purchase/renovation with one of my unit holders being an SMSF? Would like flexibility to initially contribute funds, will not involve any borrowing for initial purchase, and then subsequently for renovation costs at a later time.
Yep, good question, Roger. Let me premise by saying first, this is general advice, it's factual advice, so not specific advice. Don't run out tomorrow and do what I'm about to say. But a standard unit trust doesn't meet the requirements of the legislation. So you've got to have a unit trust that has significant restrictions built into it. And just to give it a name, we call it a 13C trust, which is a section of the Tax Act. It didn't take much brains to come up with that name. So using that trust, it allows the super fund to have a portion, and you maybe as the individual to have part interest. Now, one of the big disadvantages is you can't use the property as security for any loans. So the loans have to go down below to that unit holder. You can't buy a property off yourself. You can't lease the property to yourself if it's residential property. But one of the reasons some of our clients use this trust is over time, the super fund buys a greater proportion of that property. So as someone moves towards pension stage, they can have a higher ownership percentage. And as the individual sells down, they pay a capital gains tax. But if you do it correctly, there's no stamp duty in the majority of cases. So just remember, not a standard unit trust. It's got to be a very specific type of unit trust, and you can't use the property as security for any loans. You've got to use borrowings below the line, so to speak. And if you do need borrowings at using the property as security, then you can't use that type of trust. You've got to go to what they call a holding trust, which means that you can't work with your super fund. It has to be 100% controlled and owned by the super fund. So hopefully that answers your question, Roger.
Yeah, Brett, if it's okay, I'm going to actually get you to answer one of the questions that somebody's left live. But there are people who are watching this. Now, I know a lot of people are going to watch the replay, and more people are actually going to be seeing this on part of my podcast as well. But what I'm going to suggest is if you would like to get your specific question answered and you'd like to have a chat with one of the wealth strategists at Metropole, why not click, just, we normally say turn off your phones. Brett didn't say that. Pull out your phone and just click on the QR code or capture the QR code and leave your details. Those of you who are listening to this as you're driving along on the podcast, go to workwithmetropole.com.au or just to metropole.com.au and have an obligation-free wealth discovery consultation with one of our wealth strategists where we can show you numbers, figures that are relevant to you. And you'll find that we don't have any properties for sale. We're big enough to tip the scales in your favour, but still small enough to care because we're much, much more than another buyer's agent. We actually help our clients safely outperform the markets through strategic property and wealth advice. So those of you who are watching this, whether live or on the replay, just scan the QR code and give us your details and we'll be in contact with you. We'll find a time that works for you. And those who are listening to this on the go or listening to the podcast replay, go to Metropole. Workwithmetropole.com.au is a great way of having a chat with our team. Now, Brett, there's been a lot of questions in the Q&A segment, but I think there's one that's reasonably common. And so Courtney actually asked, for a first-time investor, do you suggest interest-only payments or principal and interest, and why?
Good question. Again, just a general overview here. But look, I actually think it's really important to get this right. A lot of people want to start paying off debt. I think we're conditioned from a young age that, being in debt's bad, but it can actually be quite advantageous. If you're paying an extra $20,000 a year to pay off a principal, in 3 or 4 years' time, that could actually be a deposit for another property. And I'm sure if you did the numbers, and the numbers have been done previously, if you just concentrate down on paying one property over 10 years, but you had the ability to buy a second property because you're paying interest only, you're actually going to be further ahead. So in my mind, there's 2 phases. You've got the accumulation phase, and during that phase, look, if you can pay principal and only, great. But if you can't, that's okay. Interest only is fine. And debt actually gets easier to pay off. That's the other thing to consider as well. And it may not seem like that at the time, but in my mind, the best time to change over is, I guess, when it's more manageable, or when you're moving into that exit strategy, when you're moving into consolidating, you want to start removing debt. You don't want to have to pay any more debt. So you can start paying down debt. You can start having some of that passive income take over. So it can be a tough thing to go against the grain and not pay down debt. But if you do your homework and the numbers, which we've done previously, and we can certainly do for you, Courtney, I think you'll find that, maybe not in 3 or 4 years, but in 20 years' time, you'll be potentially significantly further ahead.
Interestingly, thank you, Brett, because you've answered Brad Billard's question also, who says, following on from Courtney's question, would principal and interest for investments be a good strategy when your principal of place of residence is paid off? But again, it really depends upon the stage you're at. So the first stage of your property journey should be the education stage. The next stage is the asset accumulation stage. And then the next stage is the lowering your loan to value ratio so that you can eventually live off your properties in one way or another. So yes, part of the plans we put together is to eventually repay debt. But if you do it too early, you're not going to get the capital growth, are you?
Exactly right. And that's exactly what we need.
Just to add an extra point to that, when you're paying down debt on whether it's an investment property or a home, the debt component is not tax deductible if it's an investment property. And if it's on your home, it's with after-tax money, of course. Whereas if you're using that amount of money, that $20,000 that you mentioned a few minutes ago, Brett, the principal component to pay down interest, to pay the interest on an investment property, that's now tax deductible. And you now have 2 assets growing, which is one of the keystones of growing wealth. It's increasing that asset base.
Ken, I've got a quick question here for you.
Yep.
Tim's asked what the advantages of transferring the investment debt into a trust but remain. Quite sure if you got the gist of that one.
Yeah. Tax deductibility of a loan depends on the purpose of the loan. So if you take down debt for an investment purpose, it's tax deductible. irrespective of what security you gave. So if you borrow money using your house as security to buy an investment property, it's deductible. So where you draw the loan from is less relevant than what it is used for. The same as if you draw down debt on a property in a trust to buy a home, it's not tax deductible because the purpose is personal in nature. So where the debt is less relevant than what it was used for.
Thanks, Ken. Michael, another one here from Tim for you, which is as you get closer to retirement, would it be advisable to focus on cash flow properties or already have capital growth properties as his asset base or in his asset base?
So that's for me or Ken?
That's for you, Michael, yeah. For you.
Okay, thank you. Well, again, as part of the plan, yes, you should be moving to more cash flow, but that, in my mind, often is commercial property rather than residential property in secondary locations that give cash flow because they don't, no one wants them as much, so they've got to offer high yield for somebody to buy them. So it's all part of the plan of converting over time to end up having some high growth assets, such as residential real estate, and some cash flow assets, and whether that's commercial property or whether it's shares or ETFs or managed funds that also bring cash flow. I think if somebody says property only or shares only, you should be running away pretty quickly. You need a balance of property and other assets to live off over the long term.
Most people probably transition a bit too early, don't they, Michael? They buy one or two properties that might be a little bit negatively geared or negative cash flow, and all of a sudden they think they should purchase, a couple of cash flow properties and still 15 years out from retirement.
Well, they don't really they haven't done the numbers or figures to see what's going on. I think one of the interesting things you said a moment ago that not everyone recognises, Brett, is that it's easier to pay debt with time. My first investment property, you've heard me tell the story before, was $18,000. I went halves with my parents. We took a 30-year loan for $16,000 and had no idea how we'd pay it off. Now, that was in the early 1970s. Now, today, you can get $16,000, you'd pay it off on your credit card. And that's because of inflation's gone up and rents have gone up. And so if the market does what it's done for the last 200 years, well-located properties will double over the next 10, 15 years' time. The rents will double as well, but the mortgage will stay the same. And so rather than already worrying too much about cash flow this year, just be comfortable with the fundamentals that residential real estate, while it will go up and down, will be underpinned by strong population growth, continually increasing cost of construction, so it'll never get cheaper. As long as you buy in the right area where there's strong demand by people who can afford to and are prepared to pay more.
Thanks, Michael. Ken, question from Greg. Can you claim interest on a loan that was used for repairs and maintenance to an investment property?
Yeah, good question. So the answer is yes, you can claim the interest. And you've got to be careful to distinguish between, is it a repair and maintenance or is it an improvement? So if you gut the kitchen and replace it, it's a improvement. Excuse me. And obviously any money you borrow there is tax deductible and you get building depreciation. If it's a repair, I've just changed a couple of cupboards or I've replaced the carpet in one of the rooms, then if you don't have the cash and you borrow it, then it's still tax deductible and you can normally write it off in the year of expenditure. So that's the main difference.
Thank you. Michael, I've got one for you from Emmanuel Brunet. Thank you, Emmanuel. Building a property portfolio, would it be more favourable to go for 2 properties in regional towns with land to buy equity by adding a second property, or one in a Melbourne area with less land but better capital growth opportunity longer term? Example, 30 years.
I think you've answered it in the last sentence.
You don't ask a question you don't know the answer to.
If your aim is to build an asset base that in the future will be your cash machine, then I'd rather own one good property. And there's no doubt that regional locations are going to grow over the next 20, 30 years. More than that, they're going to increase in size considerably. That's just the way Australia's going to grow. But we also know that the vast majority of our population growth is going to occur in our capital cities and a disproportionate amount of that in Melbourne, Sydney and Brisbane. More than that, we're also looking for areas where wages are going to keep going up, not just for owner-occupiers, but also for tenants. And the other thing is we like areas that are gentrifying. There's little opportunity for gentrification in the more regional areas where it's not just the general market that's going up, but the younger people, more affluent people, people with bigger incomes are coming in and either doing up the homes or pulling them down and building new accommodation. And then you get a shift, a pull from the gentrification as well as from just the general market rising. And so therefore I see more opportunities, but also less risk and less volatility in owning a better property in the capital cities.
I tend to agree, Michael. I think most of those markets have probably done their dash over the last 3 to 4 years, as we explained. And I think the next opportunity is going to be with the capital cities, and it usually remains, which I'm sure we'll start to see shortly.
Yes, of questions, Brett, that people put in.
Yeah, Michael, we've talked a little bit about an exit strategy. I know you used to have the living off equity strategy. Ben's asking about the exit strategy. Is that still doable? Can you live off the equity of your properties?
Ben, I actually saw the question come in and I know who you are. I won't repeat your surname. He's a client of Metropol's. So can you live off equity? Yes, it's doable, but much, much more difficult nowadays. You actually have to show serviceability to the banks. There is a new wave of no-doc and low-doc loans and loans that some of the big banks are lending purely on equity without you showing a service income from a job as you retire, but it needs much lower loan to value ratios. I don't know what the rules are going to be in the future. Ben, I know you've got a number of years yet before you retire. So on that basis, your job is to build a substantial asset base of quality assets, knowing that the rules are going to change 100 times between now and then. As I suggested before, having your own home with no debt, having a residential portfolio, maybe having some commercial properties, maybe having some other assets. And some of the equity may actually come from actually having to sell your properties. The purpose, I should say, of owning the properties is to be able to live off them in the future. Part of it's also to give to your family in the future as well, intergenerational wealth. But one way of living off equity that we're finding people do is actually selling the properties and having the equity in that regard rather than income elsewhere. But the bigger the asset base you have, the more options you have.
Well said. Ken, from David, in my will, can I leave a personal property asset to my family trust direct? That is, include my existing family trust as a beneficiary. If so, would the estate have to pay any additional transfer duties because it is not being transferred to a person?
Well, the short answer is yes, but let me say that that's not necessarily the right question to ask. Because if you transfer it to your trust, the chances are it's been operational for a number of years, and trusts normally have got an end date of 80 years. So if you're passing it down assets into a trust that maybe is 30, 40, 50 years old, then in another short period of time, that trust will need to be dissolved. That'll trigger capital gains tax. It'll trigger stamp duty. So we help our clients move assets into a trust on death, but it's a different type of trust. And it's commonly called a testamentary trust. And the advantage of that is it's better tax outcomes, more flexibility, asset protection. Assets are protected from the family law court in a family dispute, whereas you don't necessarily get all those benefits in a traditional family trust. So I'd be asking, better trust than the one I've already got?
Well, if I could say, and Ken, you know, and Brett, you know my situation, that my mother set up a family testamentary trust in 1996. She only died 6-7 years ago. So it was 25 years before it actually ended up being operational. But having said that, she set one up for me, one up for my sister, my sibling, and it's given us in the assets she's passed on amazing flexibility, including being able to gift money to our grandchildren at preferential tax rates. So there's lots of benefits in doing it. And my advice, and I'm not allowed to give advice on this, my recommendation, suggestion would be that you speak to somebody about setting it up, because you can't do it too soon. But if something suddenly goes wrong, it would be too late.
That's absolutely right, Michael. I know where that bus around the corner is.
Yeah. So very good structure. Does the average accountant know and understand about this? I think this is one of the things that only a short while ago, I was speaking to somebody who's joining us at Wealth Retreat. I was speaking to Brent, who is probably not watching this because he was in the car just before we started this. And he's already got a substantial property portfolio. And like many people coming to Wealth Retreat, he's now planning to plan the next 5 years of his life. In fact, what I said to him was the theme of Wealth Retreat is where you're going to be in May 2030. That's scary that's 5 years away. But the information he got and the structures he's got for his 7 properties at the moment were wrong advice. And so what I pointed out to him was the sort of advice he needs is the sort that 97% of investors won't need, because they never get to that sort of level. But the sort of advice that Ken and the team at Metropole Wealth Advisory do, or the discussions we're going to have at Wealth Retreat, is for that small group of people. Brett, I remember when I first put together Wealth Retreat, some clients came up to me and said, "What now?" And I said, "What do you mean?" And they said, "We've got some properties, we've read your books, we've been to your seminars when I was doing seminars. I want the stuff that's not in the books. I want the stuff that's not on the internet." And that's what we're spending time discussing for people who are at the next level or wanting to get to the next level. But the other big thing at Wealth Retreat is the community. As we keep speaking to people who are planning to come to Wealth Retreat, many of them feel isolated. They don't have people to share their experiences with. And one of the great things is the community. And while we've got some really successful investors, they all leave their Superman capes at the front door so that there's no egos involved, and they share their ideas. So what you're going to get is not just from the faculty, but also great information from people you have breakfast, lunch or dinner with, or the drinks afterwards, or chat with the faculty. So if you want to take advantage of the new cycle that's going to come, interest rates are going to fall in due course, whether it's next week from when we're recording this or later in the year. Confidence is going to return when we've had a couple of interest rate falls, and the next stage of the property cycle is going to occur. And this is the stage of the cycle that lifetime wealth's been created in the past by those who know what's going on and have set themselves up correctly. So Wealth Retreat's a holistic event, Australia's leading property, wealth, tax, finance event, to help people. They go in with all sorts of ideas, but go home with firm plans on the Wednesday, and everyone then has a one-on-one implementation session with me. But don't count yourself out, because I talked about all these successful investors, but there's always a couple of people that we, and I'm using the word advisedly, allow to come, even though they're not at that level yet, because that's the sort of information that's going to get them to the next level. So if you're interested in joining us in May this year, at the beginning of May, go to wealthretreat.com.au and find out about it, and just leave your details, and we'll have a chat and we'll tell you if it's not for you. It's an invitation-only event, so you can't book in, because we give a money-back guarantee. I've always guaranteed it, so I've got to make sure it works for you. So sorry for the plug, Brett, but that just came to my mind that there are people listening to this, watching this, who would get real benefit from it.
Oh, certainly. Look, it's certainly changed my life. I know that's a bit of a big call, but we've had that great feedback. I've been going there for more than 10 years, and certainly wouldn't be sitting where I am today without it. I'm not sure if any of our audience actually get to go away once a year and just focus on themselves, their goals, what's working, what's not working for 5 days, and have some of the caliber of people that helps. It's certainly worth mentioning about it. Definitely check it out. You can't speak highly.
Great. One last question, Brett.
Yes, I guess we've kind of answered most of those there, Mike. If we go back to probably the last one.
Antoinette, which is about commercial property, which probably is worthwhile. Do you want to read it out?
Yeah, I was going to get to that one, actually. So for Antoinette, says commercial pays all outgoings versus residential investments that are now fraught with government requirements that largely support the tenants. Additionally, VCAT delays, sometimes up to 6 months. We're leaning towards commercial, but would love to hear your thoughts on this, Michael.
Okay, well, I own commercial, residential, industrial property. I can speak from experience, and one of my mistakes early in my investment career is actually buying commercial property too early in the cycle, in my investment cycle. So you're right, commercial property is net rents and higher yields. Again, we don't know where you are in your journey, but what you've got to do is compare apples with apples. So let me explain. If you have, let's say, $500,000 deposit with the bank's way they lend for commercial property, you could probably buy a $1.5 million commercial property. The banks would lend you the $1 million and you'd put in a third. But with that same $500,000, you could probably buy $2.5 million worth of residential property with a lower loan to value ratio. I'm sorry, a higher loan to value ratio, less money you're putting in. And that's the big difference. If you're still at the asset growth of your career and you're wanting higher capital growth, commercial properties don't in general grow as fast as residential properties, because capital growth is linked to income, which is linked to the CPI, which is going to be falling a little bit over the next little while. And if you can start with a bigger asset base earlier in your career, then commercial residential property is probably the way to go. I understand what you're saying, that VCAT or other things, government interference and minimal rental standards and government taxes and higher insurance costs. It's a cost of doing business. And if you've got good property managers, let them worry about that. That shouldn't be your concern. Your concern is owning the best assets you can, Antoinette.
It's not a good feeling though, is it, Michael? But I think a good way to answer that is, I think if I ended up $400,000 or $500,000 in front in 10 or 15 years' time, I think I'd be happy with some of those issues that Antoinette mentioned.
Good point. It's a cost of doing business, isn't it?
You said it well. Yeah. All right. Well, look, I think we're coming to a close today. Thank you everybody for listening. Really appreciate it. Thank you for your questions and being part of today's webinar, future webinars. Thank you, Michael. Always good to get your insights.
My pleasure.
And Ken, likewise. The mind boggles that what you know about those types of things. So thank you for sharing some of your wisdom.
All good, and thanks to everyone.
Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?